Something is operating on your money right now that you did not authorize this morning. Not in a dramatic way, not in a way that has changed your balance or triggered any notification. In the specific invisible way that the most consequential legal structures always operate. In the background, in the language of documents most people sign once and never read again, doing exactly what they were designed to do in the silence between ordinary banking transactions. I want to tell you what that something is. Not the fear version, not the version designed to make you panic or distrust every institution you interact with. The precise version, the translation of specific, documented, legally operative clauses in standard American bank account agreements that describe a relationship most depositors have fundamentally misunderstood since the day they opened their first account. There are 4 of them. I have read the complete account agreements, not the summary documents, not the welcome letter, the full legal text, including the sections that open with language like notwithstanding the foregoing and subject to applicable law, and that appear on pages most customers have never reached. What those pages contain has been in those agreements since before most people watching this opened their first account. It was disclosed to you. It was signed by you. And if you have never had a reason to look for it, that is because nothing in normal day-to-day banking experience surfaces it. These clauses live at the distance between you and your bank that only closes under specific conditions. This is Capital Briefing. If you are here for the first time, subscribe now before we continue. What we build here is financial intelligence designed for people who understand that the most consequential risks are not the ones that generate headlines. They are the ones that operate quietly, legally, and continuously until the conditions that make them matter arrive. Subscribe now. Activate notifications. Then let me take you through the 4 clauses. Before I do, I want to establish the foundational legal fact that makes everything else in this video structurally coherent. Most people carry a mental model of their bank account that describes a custody arrangement. The bank holds your money. You can access it when you need it. The money is yours, held safely by an institution that acts as your agent. That mental model is legally incorrect. When you deposit money in a bank, you do not place it in safekeeping. You extend an unsecured loan to a private corporation. That corporation takes your capital, deploys it into mortgages, commercial loans, securities positions, and other investments at yields significantly higher than it pays you, and keeps the spread. Your deposit is an asset on your personal balance sheet and a liability on the bank's balance sheet. If the bank's assets fall below its liabilities, if its loan portfolio deteriorates faster than its ability to serve its deposit obligations, your claim against the institution is the claim of an unsecured creditor, not a custody claim, not a property claim, an unsecured creditor claim. That distinction is the foundation on which the 4 clauses operate. A depositor who understands themselves as a custody client will experience those clauses as violations. A depositor who understands themselves as an unsecured creditor will experience those clauses as the contractual terms of the loan they extended, which they signed, which were disclosed, and which they were never given a meaningful reason to retrieve and read. This is the gap the 4 clauses live in, and it is the gap this video closes. Subscribe to Capital Briefing if what I have described so far represents the level of analysis you have been looking for. Every video we publish is built around the same framework, understanding the mechanics that operate between what the financial system shows you on the surface and what is actually functioning beneath it. The next video examines what happened to depositors in the one modern documented case where these mechanisms became operationally visible, Cyprus 2013, and what that event reveals about the conditions under which these clauses move from background legal formality to active exercise. Subscribe now. Then let me walk you through the clauses. The first clause is the right of offset. Its plain language meaning is this: if you owe money to the same bank where you hold your savings on a credit card, a personal loan, a mortgage, any debt product issued by that specific institution, The bank holds the documented legal right to take funds directly from your deposit account to satisfy that debt, without advance notice, without your authorization at that specific moment, without a court proceeding or a collections process. The offset happens, then you receive notification. The standard language in most major bank agreements reads approximately as follows. We may, without prior notice, apply funds from any account you maintain with us to satisfy any obligation you owe to us, whether or not that obligation is currently due. The phrase whether or not that obligation is currently due is doing substantial work in that sentence. It means the bank's right of offset is not limited to payments you have missed. It applies to balances that are current. A credit card balance that is not yet due can be offset against your savings before the payment date if the bank determines that action serves its interests, and the right of offset is not suspended by a dispute. If you are contesting a charge on that credit card, if an investigation is actively ongoing, the offset can occur while the investigation continues. The dispute and the offset operate in parallel, not in sequence. For a depositor holding a significant savings balance while carrying any credit card balance, any loan balance, any mortgage balance at the same institution, this clause is not a theoretical risk. It is a documented contractual capability that is exercised routinely enough that major retail bank customer service departments maintain standing procedures for the calls it generates. The structure that protects against this clause is simple and well known in institutional finance. It is practiced universally by sophisticated capital managers and almost universally unknown to retail depositors. Keep your deposit accounts at institutions where you carry no debt. If your savings are at Bank A, your mortgage should not be at Bank A. Your credit card should not be at Bank A. The right of offset requires the simultaneous presence of a deposit account and a debt obligation at the same institution. Remove one and the clause cannot operate. The second clause governs when your money is accessible after it arrives. Federal law establishes minimum standards for funds availability through Regulation CC. The rules that govern how quickly banks must make deposited funds available for withdrawal. But account agreements routinely extend the bank's hold rights beyond those federal minimums under specific conditions. One of those conditions is a deposit that causes the total account balance to cross a threshold defined internally in the agreement. When a significant incoming payment arrives, an inheritance, a real estate closing, a business transaction, an insurance settlement, into an account already holding a large balance, the bank's agreement may give it the right to hold a portion of that incoming deposit for up to 10 business days, 2 full calendar weeks. During those 10 business days, those funds are visible in your balance, but unavailable for withdrawal. They appear on your statement. They generate the balance figure your app displays. You simply cannot access them, and the hold period runs from the date of deposit, not from the date you discover the hold is in place. If you check your account 2 days after the deposit and discover for the first time that a hold exists, the hold clock has been running for 2 days. You may have 8 business days remaining, not 10. This is not concealment. The bank disclosed this capability in the agreement you signed. But the disclosure lived in a document you had no reason to retrieve until the moment the clause was exercised, at which point the hold was already in place. The practical architecture that addresses this: maintain a transaction account at a second institution, not for the balance, for accessibility. In any scenario where your primary account is subject to an extended hold, a funded secondary account at a different institution provides the liquidity bridge that makes the hold operationally manageable rather than operationally destabilizing. The third clause is account termination. Most account agreements contain language giving the bank the right to close your account or restrict your account activity at any time, for any reason or no reason, with or without advance notice. This provision is standard. What most depositors have not thought through is not the termination itself, but the return mechanism. When a bank closes a deposit account, the standard method of returning funds is a check mailed to the address on file, not a wire transfer. Not an instant electronic transfer, a paper instrument mailed through the postal system that must be deposited at another institution and then subjected to that institution's own availability policy before the full balance becomes accessible for use. A savings account holding a significant balance that is closed and returned by mail check has produced a situation in which that money is legally yours, theoretically available, and practically inaccessible for anywhere from 3 to 15 business days. At a moment you did not choose and under conditions you did not anticipate. In a normal environment, this provision operates as a background protection for banks against relationships they choose not to maintain. In a stressed environment, the specific kind of environment in which you would most urgently need access to the full balance of your savings, the account termination provision, the funds availability hold, and the right of offset are three separate mechanisms that can operate in combination. Each one is within the terms of the agreement. Each one produces a different reduction in your practical access to funds you believe are immediately and unconditionally available. The fourth clause is the one that required the first three to understand properly. It is called deposit reclassification. And its existence was not hidden. It was documented in Federal Reserve examination records for more than a decade before it became visible to the public through the consequences of the 2008 financial crisis. The mechanism works as follows. Banks are required to maintain reserves against certain categories of deposits, funds that must be held rather than deployed into loans and investments. The reserve requirement is a regulatory constraint on how much of your deposit money can be used to generate bank revenue at any given moment. What Federal Reserve examination records documented, and what virtually every major American bank practiced for years before 2008, was a bookkeeping reclassification that moved customer balances between internal account categories in ways that reduced the bank's calculated reserve obligations, without removing any funds from customer accounts, without any disclosure to customers in the moment, without any change in the balance figure visible to the depositor. The balance you saw in the morning matched the balance that had appeared the night before. What had changed overnight was the internal category against which the bank was calculating its reserve requirements, a change that was reversed before the next business day began, leaving no visible trace in the customer's account history and no entry that a depositor checking their balance would ever see. This practice operated within the framework of what was then legally permissible. It was known to the regulatory apparatus. It was not, by any technical legal definition, hidden. What the 2008 financial crisis revealed was not that this mechanism existed. Regulators had known about it for years. What it revealed was the scale of the legal infrastructure operating on ordinary savings accounts between the moments when customers thought about their bank relationship, and the degree to which the apparent safety of those accounts depended on institutional conditions that most depositors had never been asked to examine. Now let me say directly what this video is and is not claiming. It is not claiming that your bank will exercise these clauses against you tomorrow. For the overwhelming majority of depositors under normal conditions, these clauses operate as background legal architecture that never becomes actively relevant to their day-to-day financial experience. It is not claiming that banks are operating in bad faith. These clauses were disclosed, they were signed, they reflect the legitimate contractual structure of a deposit relationship, which is, by legal definition, a creditor relationship, not a custody arrangement. What it is claiming is this: the mental model most depositors carry about their bank account, the custody model, the unconditional access model, the assumption that the balance displayed is the balance available under all conditions at all times, is not the model that the account agreement describes. And the gap between those two models is not theoretical, it is operational. It operates in the specific conditions where your practical access to that balance matters most. The four-layer architecture that addresses this gap: the operating account at a federally insured commercial bank, the independently insured account at a credit union under the NCUA's separate framework, the physical cash transaction bridge in appropriate denominations, and the direct government securities account at Treasury Direct exist to close the gap between what your account agreement says and what you believed your account agreement said. Not because banking is dangerous, because the mental model most people carry is wrong. And wrong mental models produce wrong decisions at the moments when correct decisions matter most. Your bank's full account agreement is available in the disclosure section of its website. The specific sections worth reading. The paragraph describing the right of offset or set-off. The paragraph describing account termination and the mechanism by which your funds will be returned. The paragraph describing hold periods for large incoming deposits. Read those 3 paragraphs. If any of them contain language that changes an assumption you have been carrying about what your bank can and cannot do with the money you have placed there, that is the information this video was designed to surface. The clause you have not read is not waiting for a crisis to matter. It became relevant the day you signed it. The only variable is whether you discover it before the moment it is exercised or after. Subscribe to Capital Briefing now if this video changed something about how you understand the legal structure of your deposit relationship. Activate notifications. Each video we publish closes another layer of the gap between what the financial system shows you on the surface and what is operating beneath it. Drop a comment. Tell me, did you know what the right of offset was before today, and what changes in how you think about your deposit structure now that you do? The smart money has understood this since the beginning. The question is whether you are positioned on the right side of that knowledge before it becomes relevant to you personally.